Have apartment investors and apartment builders thrown in the towel in 2025? Not yet, and CBRE is reporting improving multifamily investor sentiment in Q1 of this year. For apartment owners and operators that have struggled for the past 2 years, will 2025 finally bring relief? Not yet. But recent data from RealPage does show that the multifamily market is coming into balance after a record amount of new apartments have been built over the past few years. But as MSCI suggests, some owners may be asking their investors for more money through capital calls to weather the current economic storm. Will this lead to more sales activity for apartment buyers and sellers? Not yet. This is the Gray Report. We're tracking the latest news, research, and reports on the multifamily market, housing, and the economy. Things are moving fast, and we're going to stay on top of it. Let's get started. All right, so let's just get started here on the Gray Report. I am Matt Bosnagel, filling in for Spencer Gray, who is out giving a talk at Marcus and Millichap's Multifamily Update, and I'm really excited to see what he comes back with, and I'm excited for all the audience members to hear what Spencer has to say, too. We've been working on tracking the market, and we do that every week on the Gray Report, and this week I'm joined again by Senior Analyst at Gray Capital, Addison Lubert. Addison, how are you doing? What's happening? What are the big things that happened this past week? And can you summarize basically everything in the multifamily market between the time period of April 20th, let's say, to now?
Things are going well. Great to be back on. I think this is probably the most frequent run I've had in terms of coming on.
Yeah.
In terms of you having me on. Don't think there is much panic about tariffs because in the middle of us recording last time, they got rolled back after we spent the entire episode talking about them.
Yeah. And then there was a little bit of a scare, or I don't know, maybe some excitement about firing the Jerome Powell and not firing. That happened a couple days ago. Every day is a new uncertainty. That's what it feels like for me.
Yeah, we're still in wait and see mode.
Yeah. I think that increasingly there does seem to be, and just to kind of summarize a little bit of the material that we're covering this week, there does seem to be a sense of improving sentiment among investors. And I don't know if we are just reaching the edge of that, like the April 2nd Liberation Day where things will fall off a cliff. But some of the data that we have specifically, and we'll just jump right into this article from CBRE, shows improving sentiment in Q1. Now, this, I'm not sure the exact timing of the survey here, but my assumption is that it happened before the beginning of April, which was when things were really thrown into some kind of tumult.
Before we were liberated, yeah.
Yeah, before the Liberation Day, correct. I take that at face value, and I think that will allow us to continue our discussion here about the multifamily market. Allow me, if you will, though, to skip ahead to Figure 2 of this data from CBRE. Now, this is a series of questions that they ask investors that CBRE does, and it kind of gets at what their feelings are for the market, if they think it's going to improve or not improve. And they also have broken it down into value add or core assets. So for the buyer and seller sentiment for core assets, there are improving positive sentiment among buyers. They're actually, among sellers, it's mostly neutral, but there are more positive than negative sentiment for those that want to sell core multifamily assets. For value add, it is a much different picture, and this is what I wanted to skip to originally. It doesn't look like it's a great time to be the seller of a value add multifamily property right now. The negatives outweigh the positives, and that's for sellers. But for buyers, it's mostly either positive or neutral. The neutral is the biggest category here at 50%. A little over 50% are neutral on whether it's a good time to buy value add assets, and a little under 50% think it's a good time to buy value add assets. Now, it's worth noting here that these are improved figures since the previous quarter. So even in Q4, and I just looked back in the previous reports from CBRE in Q4, there were even more sellers said that it was negative, said that it was a bad time to sell. And it has shown some fairly consistent improvements so I was looking at kind of the back issues of the CBRE report, and quarter by quarter, things were generally improving throughout 2024 and into 2025. It does suggest this momentum, or at least the fact that, like, we had a slow trough in the investment market in terms of investor interest in 2024, and now I don't know if we are hovering at the bottom or we're kind of slowly climbing up, and we're climbing up in a lot slower way than is immediately noticeable. And it still means that, like, it's lower than normal, and investor interest probably lower than normal, and probably activity too. And that's another caveat I would like to give here is I think that in these surveys of investors, there is a general bias towards optimism. There are people that, and we talked about this in, I think it was the CRE daily investor sentiment survey, or there's like the fear and greed index, and they tracked that a lot of people were planning on investing, but usually they were overshot their what their actual investment activity was. About 20% more people said that they would invest that year than actually ended up investing. So I think there's an inbuilt optimism. It kind of does make sense. You always think that you're gonna be able to figure these things out, and it's only natural, if that's their business, to want to be able to continue business. Investing is inherently, well, except I guess if you're like short selling stocks, but you always are, you have a hunch and you have a feeling, or you have a plan and you have something that you've thought about. Well, of course you're going to be confident of it. Why would you invest if you weren't? So I think that kind of explains that. But another, I guess, maybe slightly more worrying trend, and something that I don't have as easy of a way to explain, is how there's been a change in IRR and cap rate targets. Just basically quarter by quarter since Q2 of 2022, the cap rates were expected to rise, and slowly now they're expected to shrink. And at the same time as these cap rates shrinking, the IRR projections, the unlevered IRR target, has been shrinking as well. And I'm not sure if there's a way that you can explain that, or if you can shed some light on why the IRR targets would be shrinking at the same time as cap rates compressing. Because if it's an environment in which asset values are increasing, wouldn't that mean like that's an extra boost to the investment, and it would increase the IRR of the investment if if cap rates are compressing after you buy it? Or am I getting things mixed up here?
Yeah, I mean, if your exit cap is going down, then yes, that's if you're selling, that's a plus. It's a major plus. My initial thoughts on your unlevered IRR targets, and just kind of your IRR targets in general, moving down, is I think in 2022, as interest rates started to go up, and you had some equity groups that were currently in a situation of, call it bridge loans or value add deals, where you start to see your debt payments go up because you're on floating rate debt, on top of just the general uncertainty at that time, and still around now around interest rates. I think for some people it was sort of like, okay, if we want to continue to allocate money to real estate, we need to see something outsized from our kind of normal realm to get involved. So they're going to need to see higher cap rates going in, of like, holy cow, we can get, I'm not saying that this was happening anywhere in the country, but I mean, at that time period, people are like, interest rates are going up, and I'm not really sure how things are going to shake out with the deals that I'm currently in. But if you can find me a Class A deal that's 6.5, 7 cap rate, not saying that those deals existed, at least towards the higher end of the spectrum, I'm interested. Or not really interested in real estate right now. I allocated a lot of my I guess my equity or investment amounts. I was really active the last year or two with interest rates being really cheap in that 2020 to 2021 period. Now that rates are rising, I'm a little worried. But if you put a 20 IRR in front of me, and it's doesn't have a lot of a value add component, they're interested. Now,
so the higher IRR unlevered IRR targets are a result of the realization that, okay, interest rates are higher. I've got to adjust my targets to be higher to make up for both maybe the interest rates and like a riskier market.
Well, that, and also just in general with real estate, it's not, your money's locked in for a while.
Yeah.
I mean, even if you decide tomorrow, I'm not happy with this property that I own and I want to sell, putting it on the market, then trying to find somebody that's interested, and then you have a process of closing. Like, getting out of that is way longer than if you just own a stock, you don't like it.
Yeah.
I've moved on. I've told Fidelity I'm getting
glad
rid of it.
you mentioned that too, because some of this is really relevant in this current moment where we're seeing some fast-paced changes in the economy, where a month staleness in this investor sentiment could mean a lot. Could mean the difference between, all right, are they factoring in the trade war? Are they not? And also, there is an inherent lag in whether it's multifamily developers, which we'll get to in a moment, or like the sentiment, or the ways that a sale, like, is months in executing, if not like a half a year sometimes for the longer ones, that you get these deals prepared and done and everything. So there's that lag time between maybe like the initial bid and when you actually purchase the property too. So, like we've gone over a lot, there's these conflicts between short-term and long-term. And what I think is particularly interesting about the multifamily projections here is it's almost like if the investors did see the projections for the multifamily market and they are factoring in this economic uncertainty, maybe they can easily look past it because the investment period will be long enough. These short-term things are like scary. They're causing a lot of worry. They're causing a lot of worry in consumer sentiment. But when it comes to multifamily sentiment, maybe they're operating on different timescales and it takes just a little bit more to move them. And that's, I think, really going to show up really soon, if not like in the next few weeks, when we get some more data from maybe like NMHC has a survey that they put out. I know that the Fear and Greed from John Burns Real Estate and Consulting, Research and Consulting is coming out. So we'll get those updates as they come. But I think that it is interesting just to think about the ways in which, hopefully, from the position of an investor, multifamily is equipped to weather this storm a little bit better than other asset classes. That may not be true for all of the for all types of properties, but there's some legs on some of these. And I mentioned optimism before, and I was going to use in my notes I have an example of a specific market that they seem particularly optimistic about, and that's Austin. So right now we see, skipping down to figure 4 of the report, the underwriting assumptions for core and value-add multifamily assets by market Q1 2025. It lists a bunch of markets, and then it shows what the underwriting, the growth expectation for the next 3 years is. And I think that some of these are a little more optimistic, I would say, than others. I'll pull out Austin as just an example here. Now, this is for the first 3 years of an investment starting now. They for core assets, 2% rent growth, and for value add, 3% rent growth. Now, it could get there by the end. I'm guessing that this is the average of 3 years, and right now Austin is well into the negative for rent growth. And just to think that it can jump, I think it's around like negative 6% or something like that for according to some sources on average rent growth in Austin. To think that it could jump 6% into the positive, and even like 3 more on top of that is kind of surprising, especially considering that Austin is also will continue to be oversupplied, and that's not going to go away really quickly. And the same thing too. And Phoenix is maybe a little more normal, I guess, but it's saying like 0 to 4% or 0 to 3%. So at least there's that range there. But some of these markets, Charlotte is 2.7 and 3% rent growth. That may be very optimistic, or it may be that the respondents in this survey that were asked about Charlotte are in a niche submarket that's benefiting where in a way that others aren't. Or it could be something I've heard is called wish casting, where you just, if you say the wish long enough, then it happens and it's true.
Speaking it into existence.
Yeah, exactly.
Going back up to figure 2, I think there's a couple things at play.
This one.
Yeah, sorry, figure 1.
That's figure 1. Quarter-over-quarter change in IRR target and cap rates for core multifamily assets.
I think there's some other components at play with kind of just the change in sentiment.
Yeah.
If you go back to quarter 2 of 2022, or at least that initial interest rate hike, you're still 2 years removed, and even to a degree, there were still COVID fears at that point. And I think something that probably played in a lot of people's minds were you had issues in 2020 with apartment vacancy. You had a kind of a turbulent period. 2021, you saw a surge in demand, and your debt was non-existent, such that people were developing, buying, doing whatever.
Yeah.
I think in 2022, with the interest rate shocks, it's like there's another shock to the system, and that was really going to test a lot of people's confidence in multifamily moving forward. Am I still going to get the rent growth? Am I still going to get the premiums on value add projects? How are materials? How's that going to go in terms of getting what I need to do the value add? Inflation going on. There's another shock to the system that I don't think they had a great grip on how that was going to play out. I think now through 24 and into 25, I think there's a little bit more confidence in the sense of we had a surge in vacancy with COVID, with the layoffs and all the uncertainty. As we move past that, we had the surge in demand in 2021, strong rent growth, great activity all around. 2022, we had the rise in interest rates, but depending on what you bought, where you bought, where the basis was, you could be fine. What you did was fine.
The rent growth stagnation really set in on 23 and 24.
Right. Now I think with 24, it's almost just the sense of like tariffs could be happening, they could not be happening.
25,
Or sorry, 25. Tariffs could be happening, they could not be happening. All these uncertainties going around. But in the market that I'm in, I know that we have nowhere near the supply that we need.
Yeah.
I think there's a lot of that. And another part that I think plays into 22 with kind of the higher IRR thresholds and those targets is 2022 and moving a little bit after, there was a sense of like, what are these properties really worth?
Yeah.
Because with the run in interest rates and everything, there immediately was a huge buyer-seller gap throughout the end of 2022 and into 2023 of the rents and everything that the rent and incomes that these properties were generating. Yes, if they went back to the interest rates that they bought at or that they could have sold at in 21, 22, that pricing was not around.
Yeah.
And so I think there's just a weird sentiment of we have no idea what these properties are truly worth, or at least there was enough of a gap where it's like I'm looking at a completely different market or a completely different world than the person that's trying to buy this or sell this.
No, I'm really,
Now I think there's a sense of values are getting to a level that people can make sense of. Yes, there's still people that from a certain vantage point overbought or maybe chose the wrong strategy. But I think now moving forward, people are comfortable with roughly in this market, this is what I should be seeing on pricing. I'm comfortable with it. And at that point, when you're comfortable, then you can maybe start to get your investors or equity on board or whatever components are at play to say, IRRs or whatever could be a little finicky. They could be all over, but this property generates cash or this property does other things that you're looking for.
Yeah.
I think it's a combination of those things of just there's been enough shocks to the system and yet apartment demand is still going strong.
Yep.
People are okay with it.
Yeah.
And so I almost think there's a little bit of resilience of just like, hey, we've seen a bunch of shocks to the system. We're still here.
Yeah.
I'm fine now.
So that's what I was thinking about when I was gathering all these notes. Is one is the the long-term trends of investor interest and apartment development, which we'll get to in just a second, and how that may or may not coincide with interest rates. And I brought those up. And it is interesting to see the investor interest and these quarter change in unlevered IRR targets, how they went up even in Q2 2022. And that was just at the start of the initial interest rate increases by the Fed. So people caught on relatively quick in terms of what they're targeting. However, I think that the length of some of these deals, like you said, you get everyone board, you get investors on board, and that changes and that gives some deals a little bit of momentum. I think there was probably, in terms of like buying, selling activity, there's a little overhang in the actual activity. But when it comes to their expectations, they upped their unlevered IRR target because they're levered. IRR target was going to go down anyways because of the rising interest rates, and they were anticipating that even as soon as mid 2022, which was a period in which interest rates, the Fed funds rate was only beginning its wonderful journey up to above 5%.
Also, in this time period of elevated interest rates, and I'm already going to kind of contradict myself because there are plenty of people in the camp at the end of last year that thought moving forward we would start seeing more rate cuts.
Yeah.
And we would be seeing less, or I shouldn't say less, we'd be seeing lower interest rates than where we're at now. And that largely has not,
so that's
happened. But
yeah.
I think where some people can get on board now is, hey, I signed this up, this deal works at a 5, anywhere, above 5 interest rate. Mm-hmm. What happens if in 5-7 years interest rates are back in the 3s or 4s, and you can get a lot of people excited about, rates are going to go down, as opposed to we need them to get back in the 2s again so we can make money.
Yeah. I think that the way that investors can get interest, there's that little lag period, and I've been thinking a lot about the conditions now versus at the beginning of the pandemic. There's another article that that kind of invokes the pandemic as a similar economic disruption, and I think that when things in April 2020, basically, the apartment market was pretty well set up. It had years behind. It was at the tail end of years of stable rent growth. Apartment supply and demand were pretty much even, pretty balanced, but the future looked a little uncertain. Mm-hmm. And now it's a little bit flip-flopped, whereas our past was a little uncertain and shaky. We're coming off of not stable rent growth, but more like stagnation and low rent growth, high supply, unbalance, and we're finally coming out of it. Our past has left us a little more vulnerable, but there are a positive trajectory that we can see beyond the immediate future in a way that was a little bit shakier during those initial months of the pandemic. And I think you've added something too, in which the operators, people that have figured out how to survive in this climate, and they know what makes sense. That will make it easier to, I think, price apartments too. Is give them a little more confident on what they're bidding, that they're not overbidding, and they know, it's that hard. This is what our price is, and we'll have to see, because part of the answer here is that for certain properties, like value add properties, it's a negative. There's negative feelings around selling them versus buying them. So there's going to take a big push and a big motivation that we will get to shortly in the Gray Report this episode, and see what might motivate sellers to sell. Moving on to RealPage, more of these longer term trends and how they interact with the current market and with interest rates. So we've been following apartment supply metrics ad nauseum. Like Addison said, maybe at the beginning, another week of supply and demand in the multifamily market. But things are changing, and there's always kind of some new nuance. And I think especially right now, when things in the economy are so unpredictable, it's nice to juxtapose that with more longer term trends that you can at least be a little more confident about what's going to happen next, rather than the squiggly line of whatever the Dow is happening and whatever's happening day to day on that. Right now, what we're looking at here, and this is what RealPage's inherent argument here for the article is that permits and starts, after sinking down for a while, they may be going up a little bit. They really only have like a couple data points to hang their hat on, so it's very much up in the air. But there could be a general trend of maybe the ship's starting to right itself, maybe supply in terms of the beginnings of projects. So permits happen at the very beginning, or not the very beginning, but permits are the first thing that the government at least tracks when you're coming into construction of multifamily buildings. And there may be other things, but that's the one I'm familiar with. That's a common early stage data point for a construction project. And then after that, there's starts that happen a little bit later, and then completions after that. So for both permits and starts, they peaked in about January 2023, and the trough, or the low point, was about January 2025. It spent 2 years getting down to this point, and the reason is, and I'll bring the chart up again, is this is when interest rates were high. Interest rates had almost peaked by January 2023, but it's interesting to see, and again, I'm talking about the lag time between things and how during the period of like 2022 to 2023, interest rates were rising, but also construction starts and construction permits were also rising. So there was momentum to this interest in construction, which suggests that they were not just responding to whatever interest rates were. They saw the huge demand and they said, yeah, I know interest rates are getting higher and higher. We're just going to keep building and we're going to keep these projects moving. Now, by January of 2023, which is about the peak of interest rates anyways, the projects started going down. And I think that there's a perfectly good reason for that. It was interest rates, ultimately, interest rates on top of low rent growth, which was starting to emerge in 2023, especially around like March or May or whatever. It really, set in that this is what your rent growth is, and this is, with those kind of projections, maybe it convinced people to build a little bit less. And when I say less, I mean, well, yeah, we had record-setting apartment construction, and we're still on the wake of that wave. But in terms of the permits listed here, the high point was in November 2022 at 663,000 units. And I think that's by quarter. I'm not sure if that's a year-over-year number. But anyways, that was the peak. And just to give you a sense of proportion, we're now about 445. So, maybe it's gone down a third since its peak. And I'm not really quite sure what normal is. It seems like we're approaching what normal is when it comes to apartment supply and demand. My ultimate point is, just to sell this, what was the most interesting is that it does seem like there is about a 6-month lag between interest rates moving. So interest rates start to go up, let's say around February 2022, they start to tick up, and then you don't see a deceleration in starts until, that's November. So that's essentially the peak in starts and permits, and then they start going down. So I don't know. Again, I try to explain it as maybe they were still thrilled about rent growth, but I'm sure that just like there's some momentum to apartment sales, and you want to buy an apartment, well, that's a months long process. There's almost certainly a months long process when you're finding a site to build, or you're deciding to make these kind of these construction projects. So they're not small things, and that probably speaks to the momentum. But also, maybe they just were that excited, and there was just an overhang of investor interest or of construction interest, where it's like, well, yeah, we could see a little bit. So in all, though, what has happened in the time since is a period of this stagnation, and there's been lower apartment building, and RealPage ultimately thinks that maybe it has hit bottom. There's reason to perhaps hope that things will start to go up again. But yeah, for both these developer trends and investor sentiment, it is striking to see this similar long-term trends and how they kind of interact with these short-term trends in the economy. And it almost suggests that, like I said earlier, it's like these investors are looking beyond whatever the next week is. They've got 5 years, 10 years, and more to worry about. And so even looking a year ahead, as people are a little nervous of, and we'll see conference board expectations are down for a year ahead, but investors have a 5 year or more plan. Like they're looking long term, and that's going to benefit them probably, as John Chang says, keep your eyes on the horizon. So, and I think that's what they're doing. So that is it's a promising sign, I think, for the multifamily market, especially if these builders are deciding to build because they see health and they see momentum. And I think that there is reason to think that, because RealPage itself is reporting, stronger absorption levels, and how demand is exceeding supply for the first time in a long while. So there's a lot of reasons to be optimistic about this market. It's just that the economic certainty does threaten. It's like we're not perfectly shielded from everything now, especially with supply going down. It's not all about supply anymore in the multifamily market. Now it's about job growth and the economy and household growth and all these other little things that could be different from market to market, especially for markets that may be still working on their oversupply. They can mean that they're more vulnerable to this economic volatility. And that perfectly leads into, what happens in a crisis. What happens in a crisis where you're in one of those bad markets and you need a little bit more money. You're an owner and you need more money, and you issue what's called a capital call, and you're asking for more money from investors. And this is super short, and it does highlight an important issue. And I think it's also worth going through the twists and turns a little bit of the first paragraph that they have here. It says, a public market downturn coinciding with large private market capital calls could force asset owners to liquidate assets at the worst possible time. Fortunately, capital calls tend to be highly correlated with distributions, which are typically depressed in downturns, dampening the liability requirements of mature private capital portfolios. Unfortunately, at the onset of severe market shocks, that correlation can break down, as illustrated by the spike in capital calls in March and I would say April of 2020, which is illustrated here as April 2020. And you see in April 2020 how infrastructure capital calls spiked, distressed debt spiked, senior debt spiked specifically. Infrastructure did spike. Real estate, it didn't spike. It spiked, but actually I was looking back. It looks like October of 2019 had a larger increase in capital calls in real estate. So I'm not really sold on that correlation there. But there is a significant amount of like senior debt, distressed debt, infrastructure, and even maybe a little bit of venture capital, arguably. But in that initial moment of the lockdown, the pandemic, it was very felt. It's like society, economy, locking down, and they're calling capital. And I could see why. It's really nervous. You don't know what the heck is happening. Especially in April, like you basically had like half of a month maybe to even just think about this. Maybe you were thinking about it if earlier in the year, but it got really real really fast. And considering how slow moving the apartment investment market can be, things move pretty quickly at the onset of the pandemic. So things can move fast, especially I think if you're not set up correctly. And so this is where I want to create. I think it's like sometimes I think I create like this perfect situation. Maybe it's not realistic, and this like hypothetical of distress, and their argument to return to this paragraph here. Their argument is that traditionally capital calls happen also when distributions are happening, which confuses me because I felt like if a asset is doing well and they're issuing distributions, then they don't need to issue the capital call. So there's a little bit of a logic jump there, and I'm not really sure. But if they have the data, then maybe you can prove it. And then I asked a couple people. I asked you, and I asked a couple other people at Great Capital. I asked the AI, and the AI was like, I guess I don't. So, but no one said they understood that.
No, the way that I can, I guess, wrap my head around it is in the event that during those time periods is, when you either would be doing distributions or you're doing distributions and they're nowhere near preferred return, really anywhere where you should be performing, that's when those capital calls are, I think, depending on the external forces and the market, it's when they're going to happen. And if we go back to 2020, I would almost frame that in a similar sense of the kind of extend and pretend that I talked about a while back when I was on, of the sense that the true extend and pretend was during the great financial crisis, where the banks weren't really excited to take these properties back because it's not a matter of like, oh, you screwed up, the market's fine, we can find somebody else to operate it. It's these projects aren't going well because the world economy is crumbling.
Yeah.
In the case of COVID, you have a situation where if you're in a place like Chicago, or quite frankly, just a lot of cities across the country at that point in time, your vacancy skyrockets out of nowhere.
Yeah.
And there's also the looming threat of March, April, May, and into the summer when you would have leasing season.
Yeah.
Chicago's a great example of it. All these people graduating from Big Ten colleges or Midwest colleges.
Yeah.
All these people that would have moved to Chicago to start their job. They either job never started because they didn't get it, or it was a matter of like, we'd love for you to start your job, but you're not coming into the office. Some of those kids still went ahead with getting an apartment because it was cheap. I don't know. Or some of them realized, why would I move to the city? Why would I do all these things when I can just live at home? It's not ideal, but at the same time, what's really not ideal is paying rent when I don't have to.
Yeah.
With that being said, from the operator's standpoint, your vacancy.
They were probably also seeing some real time numbers in their portfolio that's like, whoa, this is a dramatic drop off. It wasn't just the vibes of, in which I would completely sympathize. As much as I make fun of vibes, it's like that I could see the start of the pandemic, but also having that data to back it up, where they see a bunch of vacancies. That's very persuasive.
To land the plane that was my tangent.
Sorry.
I think it's a matter of just they had skyrocketing vacancy. The leasing cycle was going to be severely disrupted or non-existent. And there's that fear of, we don't know if there's a path out of here or when it's going to happen. But also, if we're at 60% occupancy, we are not going to sell right now. We can't sell right now because our valuations are going to go down. Yeah. They don't know when it's going to, and they also, on top of it, you have no idea at that point in time who the market's going to be. I mean, it was kind of, I would say, before interest rates plummeted. So there's that kind of the immediate sense of, we really need you to deploy capital and rescue, save, whatever term you want to use on the deal, because we're not going to have the reserves, or we might not have the income moving forward to keep this with us. But also, we don't really have a great exit strategy. And I would have to think that at that point in time, too, the banks were like, we don't want to take on these assets. Yeah. Now it's a sense of, with these capital calls going on right now, it's a matter of, okay, the apartment demand, again, depending on what submarket you're in, as we've talked about, or what city you're in, it might, the actual apartment demand and rent growth numbers might not be where you want them to be. But for the most part, we are still
a brighter future than there was, at least in the early moments of the pandemic. We can see a way out now. Then in the pandemic, it was darkness ahead.
Well, you can see a way out, but also where you're likely getting a capital call right now is you did a value add project and you thought you were going to get a bunch of rehab premiums that you didn't get, or you didn't get near the amount of rent growth that you thought, or your expenses jumped that you didn't think, or bridge debt. So presumably somebody else can own this asset and do a better job than you, or they can just get it at a price that makes sense and they're moving on. There's a brighter future ahead. There's somebody that would want to own these properties, and people are bullish on the apartment market moving forward in a way that they weren't in 2020. These capital calls, it's a sense of like, I don't want to give you more money to rescue something when you've proven over your 4 or 5 year, 3, 4, 5 year hold period that you can't figure this out.
Yeah. Yeah. And that,
I mean, even the most experienced operators in 2020 faced, they had headaches.
Yeah. And that's like, and maybe to repeat again, I think that's, what I've kind of coming to throughout the notes and throughout thinking this through, and all the reports that came across this week, is that a big difference between 2020 and 2025 is that the past was pretty stable in 2020, and the past was fairly unstable in 2025, or at least it was more vulnerable, more stagnation, more challenges for apartment borrowers.
I mean, if you include the Liberation Day news in the last 5 years, you've had a once in 100 year, once in a century pandemic.
Yeah.
You had record inflation with large interest rate increases, and then you've also had
increase in tariffs that are even if you've taken the baseline 10%, which people aren't talking about but are still in effect supposedly, maybe, I think, that's like the tariffs as high as they've been in the 40s, since the 40s.
Yeah, I was gonna. I'm glad you saved me there, because I was about to say I'm not a tariff historian, but I don't think we've ever tried to do tariffs at this level since.
Yeah,
I'd have to say that around the Great Depression when Hoover tried. So that's just been within the last 5 years.
Yeah, a lot of baggage, and a lot of baggage that perhaps they've been through before. If you're talking about maybe extensions that were made maybe in 2023,
right?
You know, maybe they had a 2-year loan in 2021. Now it's 2023. They get an extension because obviously that's weird. You know, this once a lifetime thing. And then 2025 may come around and they're like, well, you did this once before. Nothing happened. Great. Now next is a capital call. And I wonder, I think that the probability is relatively high, but I would love to know the numbers on if you issue a capital call, how much money you're going to get out of it. You know, if you want 100 million, or let's say 10 million from your investors, do you typically only get 8 and then you got to work on the other 2, or do you typically get everything you ask for? I wonder, and I don't always think that the alternative to a capital call is all the original investors lose their money. There's a scale. Some projects it may be that way, but there's obviously, you know, a scale of problems and solutions here that are going to leave more people in hot water than aren't.
Well, that was a great time to remind the audience that we've never had to do one of those.
Yes,
so
we never had. Yeah.
No, I think, again, to kind of, I guess, put a frame of reference, I don't know. I wasn't in any capital calls in 2020, but I think you could probably get investors as scared as people were at that time and as uncertain as people were at that time of, hey, if it was not for this pandemic, it would be business as usual.
Yeah.
I don't know about rent growth targets, but we probably would not be seeing 40, 50, 60% occupancy.
Yeah.
Because people wouldn't be told to stay home or shift their way around, or I shouldn't say shift their way around, shift their way of life. Now, I think with the capital call environment, and I have not talked with a ton of investors or whatever that have had to really
that's
be in
another
any
thing.
of these.
Like,
but
we only have anecdotes at this point.
Exactly.
Yeah.
I think there's a little bit of an element of, to go back on what I said, like, hey guys, the apartment landscape is fine. You guys as operators have just made some mistakes that have not been able to. You guys have just shown that you can't operate the asset.
Yeah.
And at this point, you're getting to a stage of, like, even at 90% occupancy or levels where the deal should be performing well, you're asking me, or you're telling me that I'm facing the threat of losing money, and that I need to contribute more money to hopefully just break even in the end. There's also the possibility that you lose me even more money. I'm out.
Yeah. Yeah. It's really interesting, and what I'm wondering is that ever going to bleed into the strange idea that maybe they should just sell? You know, you'll do capital calls, or maybe then you will get another line of credit, you know, to help keep the deal moving along. And at what point does selling at maybe a little bit lower price than you thought become an option? And at what point does it become a necessity? Is going to be really interesting. And I think that now more than 2023, it may become a necessity for people. As much as we were talking up the beginnings of the multifamily market, like showing positive momentum, and I think things are coming in, and that's just like, that's not going to be realized until 2026, and it may be a rough road in 2025.
Yeah, the equity component I don't entirely know, because with the equity, I think there'd be a little bit more of a buy-in of, we really don't want to do another capital call. And if we don't have to do, I'm sure they're going to do whatever they can to skirt having to do a capital call.
Yeah.
okay, yeah, we missed the target on a sales price, but in scenarios where your returns aren't what they thought, at the end of the day, if you're not losing money, people can swallow that.
Mm-hmm.
It's really going to come down to where the debt is.
Yeah.
Because a lot of these lenders are going to say, we've done the extensions, we've done workouts, this just isn't working.
Mm-hmm.
And if the valuations are such that the debt knows, at the very least, we will get paid back, which is all they care about.
Yeah.
Yeah, you're going to start, people are going to be forced to sell.
Yeah. It's
great, and hopefully a lot of it's in the Midwest, specifically Indiana, Ohio, Kentucky, and Michigan. But
yeah. Well, and I think about this too, and I alluded this before I got caught up in something else. Is like I tend to maybe invent a borrower, that may or may not exist in the real world. I think we may be overhyping the fact that these capital cars are happening. We don't have the data. We've got MSCI that may have the data, and they wrote this. They wrote about capital calls right now. They're contributing to this conversation. They're making it more prominent. They're letting that's enough of a spark for me to want to discuss this on the Gray Report. Is the fact that MSCI may know what's up. They don't have they only have in this graph data going from early or late 2019 to mid 2021. So they don't have the current data on capital calls right now that they're showing us. Maybe behind the paywall or whatever is data on capital calls that shows that they are actually increasing right now, because anecdotally we are just hearing from a lot of our investors that I'm in this deal that they're asking for more money and
that's why we can't contribute.
And that's why we can't contribute. It's like, all right, fine. But I also, again, I think about this worst case scenario of, and I wonder how common it could be, whether in all or in part, but all of these kind of compound on each other. So is there a group of multifamily owners who maybe they borrowed with a floating rate loan where the interest rate has gone up? That's one. And maybe it was a value add project that has been challenged by rising expense and renovation costs. That's to go back to the CBRE. You see how it's a negative time to be a seller of value add projects if you're comparing them to different ones. And then also, we are in this extended period of high interest rates. Interest rates have not come down. And also, expenses, I said that, but low rent growth has also been a challenge, and that may not be happening. And then finally, not just nationally, they could have their value add, unfortunately timed loans for multifamily properties that were in specific markets that are going to take a while to come into balance. Like maybe it's in Austin or Phoenix or Charlotte, where it may take a year or two to even get to regular rent growth. Maybe the CBRE, the predictors, the survey respondents that were responding and saying that rent growth in Austin was going to be 2 to 3%. I don't know if that's going to be for all markets, and particularly it may not be for value add, but I can imagine a value add borrower that borrowed in 2021 with a floating rate loan that has, that's dealing with low rent growth and is located in Austin, Phoenix, that may be a non-zero amount of properties, investors, companies. And so we'll have to wait and see if those opportunities emerge and how much they really move the market. Maybe the number's smaller than I think, but in a situation where sales activity is low, that may set prices in a more substantial way than if it were a more active market. Because right now it doesn't seem like much is moving. It's a big not yet that I said. But yeah, I think that the likelihood is that we could see a little bit of select drama and some good stories probably, but yeah, that's going to happen, at least the way that we projected it, and what we were trying to look at is, in terms of spikes and loan maturities, is in maybe the second half of this year. In terms of the specific timing, however, there are signs I'm blanking on the name of the source, but I think it was Cred IQ was showing that multifamily loan delinquency was going up, and they were showing there were also other signs of what they called distress, but was really just servicing and delinquency, not technical distress, but these signals for distress were steadily increasing, and in a way that didn't jive with our earlier research that said that 2023 was this spike. No, the spike, and it may not be a spike, maybe a wave that's slowly building, has been building on the back half of 2024, and will be, even worse in 2025. That's when the real exciting stuff comes for if you're going to be a buyer. But again, if you're a borrower, you may not get relief soon enough. That's and that's something that we've said time and time again. So maybe everything will work out, and there will be no drama in that case. I'll have to hang up my hat on the Gray Report, because I think that there's going to be some exciting stuff, and I'm pretty confident there. But among those that are less confident, if you like that segue, are consumers, because consumer confidence is wavering amid economic uncertainty. This is what is, I would say, is a little bit of a no-brainer of an article, but it helps to contextualize the greater economy that we have been only really vaguely referencing for this episode. It is an important context, and again, like if we're approaching this situation where apartment supply, it used to be like the only thing you needed to track, because we had steady rent and we had a relatively stable economy. There's some instability, and there is some shakeups in consumer confidence that are happening. It's worth tracking. John Burns Research and Consulting says that they conduct quarterly pulse checks of U.S. consumers to identify timely inflections in consumer sentiment, shifts in expectations, impacts of policy developments such as DOGE actions, and they conducted their most recent survey from March 7th to 16th, gathering responses from 1,271 households. I like their date. CRE didn't do a date, but John Burns Research and Consulting provided a date. It's so useful, especially when things are moving so quickly. At least we know now when it's coming and how we can kind of factor. And specifically, we know that this came before the Liberation Day, so we can maybe expect things to get shakier, to be even shakier in terms of their confidence right now. I'll pull up some other data sources in a second here from University of Michigan and the Conference Board. But the upshot for this, right at the lead here of the John Burns article, is that more people are pessimistic than they're optimistic. The biggest increase was between Q4 2024 and Q1 2025. It went from 14% being very pessimistic to 25% of respondents now are very pessimistic. The people that are neither pessimistic or optimistic, that shrank a little. The people that are somewhat optimistic, that shrank a little. There was a little tick up, 1% by people that are very optimistic, but on the whole, the number, what we have, 46% total are somewhat or very optimistic, whereas in the previous quarter it was, let me do the math here, 39%. So that's a 7% increase in pessimism across as John Burns Research and Consulting tracks it now. I'm going to bring in, like I promised, some information from the Conference Board, which also tracks consumer confidence and also is tracking a tumble in March. We are awaiting, so this was on the 25th, and so very soon we'll have another update, and I'm expecting that it will be tumbling again when that data comes in. But around the same time, the Conference Board was also tracking a decrease in consumer confidence, and right now this consumer confidence is relatively low. It's as low as it is low as it was in 2021, the very kind of relative beginning of the pandemic. So that's it's going to be really interesting. So 2021 was right when people were getting used to low rates, and then they started getting excited and it spiked back up again. But expectations now are down, and they have been down for months. So there is a trend, and it's declining. And what's interesting about the Conference Board report is they look at what's happening currently, and so people's assessment of their current financial situation is a little bit improved, or at least like more stable than their expectation of the future. So current, fine, but then what about 6 months from now? No, it declined. Still, more people are optimistic than pessimistic, but there's a clear drop off in the optimism there. So can move on to the University of Michigan. So again, to summarize, John Burns Research and Consulting, declining consumer confidence. The Conference Board, declining consumer confidence. And in the University of Michigan, they are also tracking declining consumer confidence, consumer sentiment, consumer expectation, and rising inflation expectations, both in the short year ahead and in the long run. People are expecting in an increase of troubles and a decrease of good things. And one of them, and they also break it down, I like this too, by politics, by your political leanings. So obviously, when a Democrat is in office, the Democrats say things are going great. I love the economy. And then right when the Republican gets in office, then they flip flop and now they hate everything. And the same thing for Republicans. But I think that it is kind of interesting that in 2024, the Republicans seemed to actually increase in their confidence a little bit more. The gap between the Republican consumer expectation and the independent consumer expectation shrank in a way that that suggests that maybe there was a nonpartisan rise in expectations, or at least, I don't know, they were less bummed out about the economy in 2024. There was some gradual progress, but again, that flip flops, and there's a difference. And if we're looking at now, we see inflation expectations similarly. They were higher for Republicans during a Democratic White House, and Democrats were lower. And then when the Republicans were in the White House, the inflation expectations were a lot tighter between all of them. But I think that was because this was the pre-pandemic era where it was less of a topic. Right?
Nobody talked about it.
Yeah, nobody talked about it. So that's actually good, normal, and I like to see that people are agreeing with each other. And they break it down to even more like near term. I thought this was actually what I was looking for here. They're going month by month here and showing how the consumer expectations have gone down even among Republicans from February to April. And I would say like first of all, that's very low data points, and second of all, it's going down from like a 95% to like a 90% for Republicans, their expectations. So they're very bullish still, but the fact that they're all going down means that there is a nonpartisan part of this. It's across the board. People's expectations are going down. So there's some of this that can be explained by partisanship, some of them that can't. And I want to return back to the idea. And so the same thing can be said for inflation. Obviously, you see even in Republicans and Democrats, there is a near-term increase of year-ahead inflation expectations for both of them. So that's the summary of those two. And I want to complement this with this John Burns Research and Consulting. There is, some worries about the economy, and they also say that spending cuts from DOGE have impacted 9 out of 100. So there was like basically 10% of people were affected by DOGE cuts. This is households. Someone in their household has been affected and either will lose or hours will be reduced. So they have been impacted in some way. Now, yeah, that's 9% total out of 100%. And that may be like relatively small compared to like the 80% that it's not applicable, and like the roughly 90% that's not, but that's still like measurable. It is a factor, like a measurable factor there. And I'd be interested to see how the tariffs shake out as a factor as well. For job security, there's decreasing job security, but I would say largely it is okay. It's not in worrying territory, but that's another. This has been decreasing throughout 2024, and more people say that it is not as great of a time to buy a house. What I wanted to kind of to bring in here also, and I reference it, and I almost said it before, is like, remember the idea of the vibe session, where it was like, oh, the economy's bad or not really bad, but everyone's feeling bad. And people were pointing to, progress in inflation and low unemployment and and relatively high GDP and healthy retail sales numbers, but they were still saying, well, people feel bad. Their feelings are wrong. And they called it a vibe session, and they made fun of it. And is this another vibe session? And can we make fun of it?
Yeah, I mean, yes and no. I think something that I think puzzled a lot of people, and I think it kind of came to fruition at the end of the election, is rising inflation definitely shocks the system. I shouldn't say shocks the system, but I think has an effect on the psyche of the consumer way worse than unemployment did, and this did or does.
During the great financial crisis, the Great Recession, I think I would say that inflation bumped people out more than that.
It's a weird thing because with both the economy and then when you look at kind of the political effects, and I mean, just how they kind of intertwine, there's moments where anecdotes can be really telling, and then there's moments where anecdotes can be just useless.
Yeah.
I think what was really on people's minds and really dragging people down in the sense of consumer confidence during the height of inflation, especially in 2021 where there was still supply chain issues, is I'm going to a place to go get a sandwich and they're telling me they don't even have tomatoes.
Yeah.
And it happens all the time. Whereas like pre-inflation, it maybe happened if the delivery truck just didn't show up, and that was once in a blue moon. Or they're telling me they're running out of this, or they don't have this
they get
anymore.
Constant reminders
On top of the fact that what I was buying, 5 years ago. I mean, if you're somebody that was buying a cup of coffee every day or just buying something on a regular basis, you have that sticker shock, and you can constantly remember to yourself, hey, in 2019, this is what I was paying every day for a cup of coffee, and now I'm paying this. And on top of it, it's not like it was just limited to one product type. It was when you filled up your gas tank, gas was more expensive. When you went out to eat, it was more expensive. When you went to Home Depot to buy something to fix up part of your house or whatever, that was more expensive. There was no escaping it.
And when you were getting gas, that you would see the pictures of the president, and they'd be like, I did this. I made the prices high. That would also remind you, right?
Right.
The sticker.
Sure. So there was really no escaping it. And I think that there either wasn't a sharp enough decline in prices, or it was just the numbness of everything's more expensive. Even if one thing has gone down in price, everything is still expensive. And so I still think you saw a lot of people, I mean, even throughout last year, just saying, the economy's bad, the economy's bad. Yeah. And it was fascinating because, I mean, I remember Taylor Swift came here for a concert in Indianapolis, and Gamebridge was filled, and the cheapest ticket was $2,000. And it's hard to wrap your head around, like, a bunch of these people have $2,000 to just drop on a concert ticket.
Yeah.
But I'm supposed to believe this is the worst comedy you've ever had.
Yeah.
I don't
support local artists, local bands, and we won't always have to pay for Taylor Swift.
But it is a frustrating thing to see because, I mean, even then they talked about this on an episode of the Trepwire show last year at this in summer of 24 when they were doing economic data and kind of consumer confidence. 50% of people had said that last year we were at record high unemployment.
Yeah, they just didn't know. Yeah,
and it's like,
that is super interesting because they're different categories, but it's just the vibes of the economy. They don't have to separate unemployment with inflation. If they see high prices, they just think, oh, economy's crazy.
So, I think some of it is, yes, I think unfortunately, and given just the makeup of our country right now, especially from a political standpoint, a lot of this information and this sentiment is going to be based off of how people feel about whatever political party is in power, especially as we continue to start viewing political parties not as political parties but as sports teams and kind of a tribal sense.
Yeah.
I think where things are starting to get interesting now is with some of the Doge cuts, or at least proposed, and just some of the actions taking place by the current administration. I think there's some people that are realizing, I didn't know this service or this part of the government or whatever, I didn't know this impacted me.
Yeah.
I didn't know what this
Yeah.
meant, or I didn't realize its presence. I also think what some people thought was awful about the economy in terms of inflation, namely price of eggs.
Yeah.
It's a little bit of a sticker shock now, and this is where I hate to use anecdotes,
Yeah.
but I think it has to grate on people. You go to grocery stores around here. Sometimes, I mean, a few times I've gone to Costco, they don't even have eggs.
Yeah.
So you
Or
went
the
from
eggs that they have are like tiny and not the color you want.
no, completely out.
Yeah.
And I think some of those things are going on the American psyche of like, whoa, we had this supply chain crisis in 2021 where some things weren't available,
But also,
now they're
Addison-
just not. And also, when some people thought, all right, $4, $5, $6 is expensive. Now if things are $10 or they're just not available, and this is before a good chunk of tariffs have taken place, it's hard to ignore that.
You know, they put the president pictures on the gas prices saying, I made this. I want to put a sticker on the glass case in front of the eggs that say, please note, egg prices are the product of industry-specific conditions. It's a bird flu and stuff, right? It's not because of general inflation. It's just because of dang bird flu. We can't do what. I said it before, and it was it's always around Easter when people start to complain about it. Industry-specific conditions. I'll be making those. I'll be making those stickers shortly, and I'll put them on. And guess what? The grocery store will be like, "Thank you," and they will like it, and they won't see it as vandalism.
Yeah, the trend that I would really like to start is, the people that had the flags or stickers that said, "Don't blame me, I voted for Trump."
Oh, I voted
In
for
the
the
last
other guy.
4 years, yeah. I'd like to start making stickers or flags, but with outdated candidates.
Yeah. Oh,
So,
that's good.
Don't blame me. I voted for Dukakis.
Yeah, voted for Dole. Whoever.
I voted for Dole. Yeah.
No, that's good. There is an upshot to this discussion of consumer sentiment, and especially that John Burns talks about is, if there is less money to. If people feel pinched, whether it's inflation, whether it is low job growth, because one of these things that consumer sentiment tracks is income expectations, and they've gone down, is first of all, they think it's a bad time to buy a home, but I'm worried about a situation in which housing demand in general goes down, because usually, almost a lot of the times, is as goes the single-family home market, so goes the rental market. Now, there's been a little bit of a bifurcation here where people can't be homeowners because they don't have the down payment money, or they're just waiting it out and they remain renters. And that is a factor, although I haven't seen the specific numbers on that. And I've been searching for 5 years and I just haven't found it. But I think that we are getting close to, if these worries are true, we could be approaching a point of time where home values go down, where as a result, and again, this is an outside chance, but it's still a possibility I think people should think about. What if the economy goes down so much that rent growth is no longer insulated? Rent growth goes down, home prices goes down, and we don't have the sunny future that we thought that we'd have by 2026. We've got another hole that we have to dig out of. Sorry, I had to get that off my chest.
I don't really see too much of a scenario where rent growth goes down outside of the markets we've already talked about, where supply and demand, there's too much supply or peak supply, where that's affected the current market. The only other way that I could see rent growth going down is just economic issues, similar to COVID or similar to the great financial crisis, of a lot of layoffs, incomes aren't going up or whatever. That has remained to be seen. I'm not an economist, so I'm not going to look forward and be able to say that I think massive unemployment or anything along the way is going to be coming. I think the housing situation, though, is a little different in the sense that you kind of have to think of, again, who's going to be selling an apartment complex right now, who's going to be selling their home right now.
Yeah.
Some people where the parents just want to retire and they want to get down to Florida or Arizona or wherever as fast as possible, and they don't care, or they're giving it to their kids. Or you just have a scenario where, and the explanation of it was great in a real estate book I read a long time ago, no matter what's going on, whether you're having the best economy or the worst economy, people get pregnant and have kids.
Yeah, there's
and they
always
need to
going to
move.
be. Yeah, yeah.
People die.
There's another
shifts
job
that happen.
somewhere.
Right. So I don't want to make a guarantee or anything, but as the saying goes with stock markets, of like when everybody's panicking about the market and prices are low and there's all this concern, if you have the cash, great time to buy.
Yeah.
If you're thinking about buying a house right now, might not be the worst time,
Yeah.
right? I mean,
Yeah.
if general people are concerned, then and you can make it work. Yeah, I think it's worth something looking into. But I think something else going on right now is if we go back to COVID, it's remarkable how much we've talked about COVID this episode and reliving 5 years ago. With COVID, there was a huge sense of panic and frustration of, at a minimum, we're taking this 2 weeks at a time. Hopefully in 2 weeks from now, the cases go down.
Yeah.
Hopefully in 2 weeks from now, hospitalizations or whatever go down, and maybe we can open up the restaurant again. Maybe we can do outdoor dining. Maybe we can do, we can go travel or whatever it was at that time. I think there's a little bit of frustration. I don't want to say a little bit. There's definitely a frustration going on right now of everything's wait and see.
Yeah.
Tariffs might be happening or might not be happening, such that at where I work, we might go ahead with the project. We might not go ahead with the project. There might be this, there might be that. Then they leave work. Well, I don't know if we want to move into a home because if it costs money to do, renovate the kitchen or whatever, I don't know how much a dishwasher is going to cost. I don't know how much this is going to happen.
Or switch to, if you can't pre-order the new Nintendo. Can't even do that.
Sure. So there's too much of that. There's too much I don't know. And based on what we've read in this in these articles about how people's perceptions of the economy, political parties or whatever.
Oh yeah,
I tend to think there's a little bit of, like, even when they go to job security, 2022 in 2021 even, there's a sense of like, holy crap, not only can I be secure in my job, but the job market right now, I could leave and make more.
Yeah.
And now there's this weird thing of like, I might be fine with my job, but if this project doesn't go, I don't know. Also, I don't know if I can find another job.
Yeah.
There's no layoffs going on like the great financial crisis.
Yeah.
But I think there's just a little bit of like, everything is chaotic right now.
Yeah.
Everybody that I'm talking to has no idea. And also, part of the shock to the economy right now is tariffs. The people putting on the tariffs don't know if they're going to do them or not.
And I haven't even talked about interest rates. And I was going to note that for the past couple of weeks is 2 weeks ago we talked about
Jerome Powell doesn't know what's going to happen.
Jerome Powell doesn't know if he has a job next week. No, I think he's okay, right?
Anytime I see him, I'm sure he's like, you know what, I could just be done.
Yeah, well, and he's like, it's like, I wonder if he does have that attitude of like, well, if I'm going to be fired anyways, then I'm going to walk around like I own the place. Like if you give in your notice already, your 2 week notice, and you're like, interest rate hikes, whatever.
He's taking
you can't touch me.
3-hour lunches.
Yeah. He's quiet quitting.
Yeah.
No, I wanted to talk about this. So interest rates, and particularly here, let's edit this graph to make it a little more grand. This is a month. I've got in blue here is the 10-year treasury, and I made the line a little smoother, so I have like monthly data. Let me edit this and format it so that it is not monthly and it is daily for the 10-year. Okay, so it's a little squiggly, but we get more info here. You see how in this, so my point is the 10-year treasury is still high. And 2 weeks ago, we talked about the 10-year treasury. That was weird that there's economic volatility, but usually what happens when things are volatile, people buy bonds because, well, that's less risky. And so that makes the 10-year treasury yields go down. So it's a nice little release valve. It makes sense. I understood it. I was confused 2 weeks ago. And then like immediately after we recorded, I started reading articles about how, no, this is why. And it made sense. I just wish I read them earlier. But the reason why was essentially, and I think you can get like into the geopolitics of it, but essentially people bought less bonds because they didn't see them as safe anymore. Before they were this safety valve, and now they're not a safety valve anymore, slightly not a safety valve, or not as much as they used to be. So that's why yields are staying are staying up is because they see the economy is risky, but they certainly don't see but they also see like bonds as a little bit risky too. Like maybe the U.S. won't pay him back. Like I think that's a little far fetched. I think we can treat them as safe, but this is what's happening, and there's no getting around it.
Yeah,
and so that circling back to investor sentiment and consumer sentiment, I think that having an elevated period of high interest rates has got to be a big drag on sentiment. It's not nice. It doesn't make me feel optimistic about stuff when I know that either whether it's a multifamily project or a new home, I've got to pay all this money just for the cost of the loan. Whereas before, didn't have to do that. I don't think people are used to it yet.
I think, right. I think it's a combination of that. There's a lot of people in real estate that were in the 70s or 80s that will happily tell people my age, think about how high interest rates were when we were buying homes or whatever.
But the whole system was set up differently than that. We have to deal with this change, and that's what, and it seems like, expectations are taking a long time to get adjusted here.
I shouldn't say I think. If you look at the run in interest rates, it's centered around the time of the Russia-Ukraine war. There's massive supply chain issues going on at the United States and quite frankly across the world at that point. You had the Suez Canal issue that kind of halted global trade for a little bit. On top of the fact that you're still trying to get out of a pandemic and you're trying to get back to an America, a normal America, if that exists, but also just kind of a normal world. You kind of put that 5-year stretch together, you start to almost feel like, okay, the people that we thought had things under control don't have anything or don't have it under control. Not sure what's going on.
Maybe.
And
the bond buyer thinks that, like, this has been shaky. I'm going to buy less.
I can't speak to bonds. I'm truly speaking to what you had said of just there's fatigue and people are going on because it's like, well, interest rates will go up, but this stuff should such and such happens, and things are going to go down.
Yeah,
they haven't. Yeah, and at least in America, one of the things that the voters love doing is just constantly hitting the ejector seat on whoever's in power.
Yeah.
Well, we've done that how many times? Interest rates are still high. Inflation's
That's
still
why
up.
Let's eject Powell and get the rate cutter in there.
I think it's generally associated with a sense of things are out of control.
I will say that
the bunch of people that we thought should have been handling things or things we never thought would happen are now happening.
Yeah. I think that the market reacted negatively to the idea that Powell would be fired, and I think that that's probably some validity in if the Fed chair was always under the hot seat and was subject to the political whims of whatever the popular opinion is, there would be little stability, it'd be even more volatile. So I think that that's probably not likely that he'll be ousted, but we'll see what happens, when his term is up. And I also think that there's a whole board for the Federal Reserve, so it's probably there's maybe more stability inherent in that than just one person that can move things.
The current administration has shown no problem firing people. I think if they want to fire Jerome Powell, they will fire Jerome Powell.
Finally, he's boring. Let's bring in something, put on a little show. No, that's I think that there's a really good logic there, and that's why I think markets take them seriously. But yeah, these are just a sample of the things that are moving very fast and have a real serious implications for the multifamily market, housing, and the economy. We are tracking all of these long-term and short-term trends shaping the apartment market, consumer sentiment, investor sentiment, everything that impacts and everything that is valuable to know now and long-term in the future. For multifamily investors. We'll keep track of it every week on the Gray Report. And if you want to follow along on our newsletter, go to www.graycapitalllc.com/newsletter. You will get the best multifamily newsletter in the world. You'll get it every week, maybe even twice a week. It's free. It's great. It's wonderful. See you next week.